Welcome back to High Frequency Trading, a complete guide. So far in this series, we have covered the fundamentals of HFT, how it works, and the cutting edge technology and infrastructure behind it. In this fourth episode, we are diving into the strategies, the actual methods that HFT firms use to turn milliseconds into millions. From market making and arbitrage to machine learning driven models and order flow prediction, I will walk you through the most common and powerful HFT strategies used by top firms across the globe. We will break down the logic behind each approach, how they are implemented, and what makes them so effective in fast-paced market. If you have ever wondered how HFT actually makes money, this video has your answer. Let's jump right into the HFT strategy playback. The first one is market making. Market making is one of the oldest and most fundamental strategies in high frequency trading. At its core, a market maker provides liquidity by constantly placing both buy and sell limit order on an exchange. The goal is very simple: to make profit from the bid and ask spread. To truly understand how market making works in high frequency trading, let's first break down a few key terms. First, what is limit order? A buy limit order, a sell limit order. And second, what is bid and ask and what is bid ask spread. So let's understand what is limit order. So a buy limit order means you are willing to buy at a specific price or lower. A sell limit order means you are willing to sell at a specific price or higher. These are different from market orders, which execute immediately at the best available price. Take an example. The market price is now 100 and you are willing to buy at 90 rupees. So you will place a buy limit order. If you place a buy limit order of 90, it means your order will flip if the price will go below 90 or at 90. Similarly, a sell limit order. So let's say you want to sell at 110. So what you will do, you will place a sell limit order of 110. It means if the market will touch 110 or above that, your sell limit order will fill. So now you understand what is buy limit order and what is sell limit order. Okay. Now the market order means if it is 100, then obviously your order will fill at 100 only. Okay. So now you understand what is market order, what is buy limit order, what is sell limit order. Okay. In this case, we'll talk about only buy limit order and sell limit order. Now coming to bid and ask. In any order book, the bid is the highest price that buyers are willing to pay. The ask is the lowest price that sellers are willing to accept. So the difference between the two is called bid and ask spread. Now let's understand this with an order book. As you can see in this order book, in the left hand side, the price is there 100.07, 100.06, 100.05, then 100, 99.99, 99.98. And this is the size in the middle, and the right hand side, the side, whether ask or bid. Now as you can see on the ask side, the best ask is 100.05 because that's the lowest price that the sellers are willing to accept. Similarly, on the opposite, on the bid side, the best bid is 100 because that's the highest price that buyers are currently willing to pay. Okay, so now you understand the best ask and the best bid. So in this order book, if you see, the difference between the best ask and best bid is 100.05 minus 100, which is 0.05 or 5 cents. That is your bid ask spread. Now that's exactly the market making do. So the market maker simply place a buy limit order at 100 and sell limit order at 100.05 at the same time. So if both the order got filled, so they will buy at 100 and sell at 100.05. So the difference 0.05 is the profit. This will happen for one trade. If they will place thousands of trades in just a millisecond and then across different asset classes, then this difference will make really good money. So now you understand how market making is actually happens here. So what essentially they're trying to do, they are trying to capture the difference between the bid ask, which is basically the spread or bid ask spread. So now let's talk about the risk. In our example, let's say the market is at 100.01 and the market maker placed a buy limit order of 100 and a sell limit order of 100.05 at the same time. So if the market is at 100.01, obviously neither of the buy limit order nor sell limit order will fill. But if the market will keep going up, let's say 100.02, then also both the order will not fall. Again, it will go to 100.03, it will not fill. 100.04, both the order will not fill. At 100.05, the sell limit order will fill, because as we know, the sell limit order is basically if the market is at that limit price or above that. As the market is at 100.05, the sell limit order will fill, but your buy limit order will be open because the market is above 100. So now you are actually in a loss because you will have an open sell position which is at 100.05. Now let's say further market will go up to 100.06, then again it will be 100.07. so what will happen is basically you are already in a loss. So maybe you have to exit from the market and you can place a market order. If you place a market order, you will exit at 100.07, which actually you sell it at 100.05. so your sell price is 100.05 and your buy price is 100.07. so your loss is 0.02 for each trade. Let's say assume you have done thousands of trades, so now you can imagine what will be the loss. The same thing can happen on the other side as well. So it's not just about placing static orders. Real HFT market makers dynamically update codes based on volatility, order flow, inventory levels and market news. They also have to manage inventory risk, meaning they don't want to get stuck holding too much of an asset if price moves against them. That's why these systems constantly balance positions, hedge exposure and adapt in real time. Now that wraps up our deep dive into market making strategies. In the next video, I will explore another powerful HFT strategy, which is arbitrage. Thanks for watching. I will see you in the next one.